Hello, everybody, and welcome to our virtual tax school webinar series. My name is Amar Medic, and I am the product marketing manager for Taxwise. In today's webinar, we'll be covering business returns basics. We will go over the ins and outs of 1120 and 1120S tax returns, all within Taxwise. Please keep in mind, we try to host one webinar per month, so if you find today's session to be informative, please be sure to join us in the future. During the webinar, you'll be able to submit questions to the team and get those answered live at the end. And with that said, I'm very pleased to introduce our main speakers for today, Beverly Henry and Lance Center. They're both solutions architects here at Wolters Kluwer. Beverly and Lance are both CPAs with years of experience working in the tax industry, and they'll be sharing their insights on how to prepare business returns. So with that, let's get started. Beverly and Lance, please take it away.
Well, welcome to today's virtual tax school webinar. I'm Beverly Henry, and we are going to be talking about different business structures, mainly focusing on the corporate and subchapter S business entity types. I want to first introduce you to Lance Center. I want to say a little bit more about him than what we just heard. He is like a CPA who is now a solution architect manager at Wolters Kluwer. And I'll be asking Lance some questions as we go along because he has a whole lot of knowledge and experience in the accounting and tax industry. He's worked in it for over 30 years, and most of those years, Lance owned his own successful full-service accounting firm, working with the different entity structures that we will be covering today. And as I mentioned, I'm Beverly Henry, also a CPA, and I started here a little under 2 years ago at Wolters Kluwer as a solution architect, but previously, previously worked in public accounting for about 10 years. And in fact, I worked some of that time with Lance at his firm, and I'm happy to be back working with him on his team here. So my role as solution architect, that means I show our solutions, presenting the tools in our software that create a more productive and streamlined process for you. So during today's webinar, we will mainly be focusing on S corporations. And then towards the end of the webinar, we'll see what the return looks like in one of our tax software solutions, Taxwise Desktop. So what are the common types of business entities? The 4 common types of business entities we usually see: corporations. And incorporating a business, that creates a separate legal entity, so generally its owners are not personally liable for the debts and liabilities of the business. Their personal assets are protected from business creditors, and this is probably one of the biggest reasons a business incorporates, for legal liability protection. And most large businesses are organized as corporations. And because it is a separate entity, it reports its income on its own separate tax return and pays the federal tax. And those subchapter S corporations. These are corporations organized under subchapter S of the IRS code, commonly called S corporations. The main difference between a subchapter S corporation and corporations lies in their tax treatment. So a subchapter S corporation, it's a tax vehicle, and in other respects, it is a regular corporation, but files a Form 1120S and doesn't pay federal taxes. So owners of both are called shareholders. Now, the other types of business entities can include partnerships. A partnership is a joint undertaking by 2 or more persons to make a profit. A partnership does not pay federal tax. Each individual partner reports and pays tax on their share of the partnership's income. A partnership can even be formed by two or more individuals inadvertently by working together to pursue a profit. Conversely, a limited partnership must follow statutory formalities. And owners of partnerships are called partners. And limited liability companies, LLCs, they are state law creations that are neither corporations nor partnerships, but borrow traits from both. LLC owners are called members, and LLC members also have limited legal liability under state law. The only return type that pays federal tax at the entity level is the corporation on Form 1120. The other return types are for informational purposes to the IRS, and their income and losses will flow to its owners. Well, I'm thinking this might be a good time to bring in Lance for some questions. So Lance, if you can hear me, I know we were having some microphone issues earlier. So Lance, you can hear me?
I can, yes.
Okay, good. So a limited liability company, it's not a corporation, nor is it a partnership. So what tax form does a limited liability company use to file its tax return?
Well, the short answer is yes. It files. No, I'm not trying to be cryptic here. Limited liability companies kind of sit in their own realm. Uh, Limited liability company is an offshoot, essentially, of the corporate and partnership world in that, as you mentioned already, Beverly, corporations, there's no protection. Well, there's total protection for the shareholders, right? The corporation's responsible for the debts. The shareholders have an investment in that corporation. When you move to subchapter S, there's a certain amount of liability there. Partnerships are fully liable for everything that happens in the partnership, even if you're not the partner that did it, right? So you have to think about that. So somebody with a higher pay grade than I did came up with an idea of a limited liability company. A limited liability company acts like a corporation in that it has that legal separation between the owners of the limited liability company and the affairs of the LLC. So if the LLC, has a debt, in theory, the shareholders are not responsible personally for that debt because of the wall that's built by the limited liability companies. Now, you could build the same wall to a certain extent with partnerships and S corporations, but limited liabilities are more streamlined in their setup, easier to set up. Now, LLCs do not have to have more than one owner. A partnership, for example, has to have more than one. You cannot be a partnership without a partner. Okay, you can be a subchapter S with only one. You can be a corporation with only one. But partnerships require at least two individuals, two companies, two partners to be in business, hence the name partnership. So there needed to be something in between. So LLC was created. LLC, it's not exactly check the box as far as how you want to report, but limited liabilities can report as a partnership. By their very nature, it's two or more partners involved in business. They're called members, but it's two or more entities or people conducting business. Therefore, by its nature, if you don't make any election, it files a partnership return, a 1065, with a box check that indicates it's an LLC. Now, if it's a single member LLC, let's say, in my accounting practice, for example, I'm the only owner and I'm an LLC, I can't file a partnership return because it's just me. Now, so what would I do by nature? It would be a Schedule C. A single member LLC is what we call a disregarded entity. You'll hear that term as you enter into this realm. What's a disregarded entity? Well, it is a partnership by IRS standards, but since there's only one person, the partnership rules are disregarded and it's treated as Schedule C. And then finally, if you want a limited liability company, but you want the benefits, which we'll talk about later, of subchapter S election and the subchapter S corporation rules, then you have the ability by filing an election form to treat your LLC as a subchapter S corporation for tax purposes and file 1120S. So big answer for a quick question.
Well, I actually have another question for you as well. What was the most common entity type you saw when you were practicing? And what possible issues could there have been if someone came into your office after they chose the wrong entity type?
So I got into them all. I did consolidated corporations that were four companies doing business in 26 states. That was a fairly large return, as you can imagine. Not very common though. Corporations used to be quite common. That was the pretty much the way for people to separate the business debts from their own personal liability. So corporation was pretty much it. Over the years, partnerships were created that you don't have that by its nature, but as you indicated, you can create a limited partnership where one of the partners is responsible as a general partner, but others can be limited partners. I worked in the agricultural world and here in rural Texas, saw a lot of family limited partnerships surrounding the management of the estate. You know, mom and dad want to keep control. They're the general partners. They give away their ranch via limited partnership shares through a limited partnership. So I saw a lot of that. And then LLCs, when they became in vogue, when they were, fairly new, everybody thought, well, I need to be an LLC. Well, they didn't really need to be, but they thought they did because somebody told them they did. So they went out and created an LLC. For tax purposes, it was a disregarded entity. It meant nothing for them, but they did get the legal liability of an LLC versus a sole proprietorship where you're fully responsible for everything that happens in the business. So there's a benefit, but it's not so much tax benefit. So saw a little bit of everything. Subchapter S was very common for smaller corporations. Had a few that were single shareholder C corps, or what we sometimes call C corps, but corporations and S corps, a lot of single member S corps, because you want to take advantage of some rules. We'll talk about those as I mentioned earlier. So saw the gamut. I think most common in my practice was partnerships. You see that a lot in the real estate world too, where real estate is owned in partnership, and then LLCs certainly during the last 10, 15 years were probably the most common organized new entities. Now, you
Well,
mentioned, second part of that question, what if you choose the wrong type? Okay. And that happens. That happens a lot. Hey, I incorporated 20 years ago because my attorney told me I should. Haven't really done much about it. Can I become an S corporation? You can, but since you've been a corporation for a while, there's some issues. Hey, I elected to be an S corporation. Am I taking advantage of it? No, you're really not. You should have done something else. Maybe you should reformulate as an LLC. What I saw more than anything, especially in the farm and ranch community, is a couple of ranchers buy a herd of cattle together, work them together, feed them collectively, sell them collectively, and split the income. Technically, they formed a partnership. Now, sometimes we would treat those as what we call a casual partnership, 50% on their returns. But for the most part, the IRS would consider them to be, for taxing purposes anyway, a partnership. Because remember, a partnership does not have to be formally organized in the state. It just has to be two or more entities or people doing business together. And then
so
sometimes,
that leads,
go ahead.
yeah,
Go ahead.
I was going to say that leads me into another question. What are the possible liability issues of when they don't realize they're actually creating a partnership?
So, for the most part, remember a quote unquote general partnership, and I've got my little air quotes up in my little air quote hands up. A general partnership is exactly that. It's a handshake. Now, sometimes they're formalized and there's a partnership agreement. In fact, more often there is at least some sort of a partnership agreement. Okay, but it's literally a handshake from what it does for you from a legal perspective. If Beverly, if you and I went into business selling widgets and we lost $10,000 selling the widgets, even though I'm the one that created the loss, you got to pony up the $10,000, even if I don't pony up my share. It is really, it's
That's
a
kind of
social
scary.
It
Yeah.
can be kind of scary, right? A partnership, I'll make it more akin to a marriage. You're responsible for whatever happens, and it's joint accounts, joint everything. And so partnerships, while they have their space, general partnerships have certainly their space, and there's reasons to use a basic general partnership, ease of use. It's a temporary thing, just want to be in and out, in a couple of years type thing. All kinds of reasons to have a more casual or general partnership. In many cases, the people who are investing together, going into business together, would like to have some sort of protection between their assets and the assets of the business. So they will choose a corporate structure, typically electing S, or a limited liability structure.
Okay. Yeah, that's it's kind of concerning how easily a partnership can be formed. And thanks.
You use the word inadvertent, and I've come across my share of inadvertent partnerships. And when I let them know they really should be filing another form, they're not happy with me typically.
Yeah.
but we've done it. They want to do it right still. They're not happy with me, but they want to do it right. So we'll go ahead and start filing that 1065.
Yep. All right. Well, thank you, Lance. And I'm going to go to the next slide with a polling question. So what do you all think is the best answer? What is an S corporation? Yep. So I'm seeing.
Let's give them a second. We've got about 40%. And Lance, just an FYI, I believe your mic may be low. Maybe check the settings and see if you can bump that up.
Oh, okay.
Yeah, I was having trouble with my speakers, and I switched to a different microphone. Is that better?
I can hear you.
Yeah, I don't know. We'll see if anyone else says it's hard to hear you next time. But
you bet.
Let's give them a
can
few
you hear
minutes.
me all right?
Yeah, I can hear you fine.
Okay.
We got 72% voted. Let's give just a minute more. Okay, I'll go ahead and close it now and share the results.
Okay.
So we've got 47% said it is a pass-through entity.
It is a pass-through entity, but an S corporation, it's not A because an S corporation does not have partners. They're called shareholders. So the answer is B. For tax purposes, the income losses and deductions and other tax attributes flow through to the shareholders rather than being taxed at the entity level.
So, by the way, is this better for anybody who's having trouble listening? I hope it's better. Anyone?
I can hear you. Well, I can hear you very
I'm seeing
loud
some
and clear.
I'm seeing some thumbs up. I switched to a headset, so hopefully that's going to help. Listen, those who answered A, you're not entirely wrong, right? It is a pass-through entity, and when we talk about pass-throughs, S corporations and 1065s and LLCs, for that matter, are the ones we typically go through. So it does say the partners report. So that was kind of the tricky part. But you
So
were,
tricky.
but you were listening, right? And that's the good news. It is in fact a pass-through entity. So I appreciate you catching that. We just threw a little curveball at you. So anyway, go ahead from there, Beverly.
All right. All right. So basically, a corporation is a legal entity separate from its owners and is formed by filing a certificate of incorporation in its state of incorporation. An S corp, a corporation which derives its name from subchapter S of the IRS and allows the corporation to make a tax election how they want to be taxed. Now, there are a few statutory requirements before a corporation can elect to be taxed as a subchapter S corporation. It cannot be a foreign corporation, must be a domestic corporation, cannot have more than 100 shareholders, A corporation can have an unlimited number of shareholders. And a subchapter S corporation can only have one class of stock. And there are certain restrictions on who can be a shareholder. Shareholders must be individuals, estates, or qualified trust. And a subchapter S disallows non-resident aliens or certain types of trust to be shareholders.
Now, before you move to the next slide, Beverly, back up one.
Okay.
Let's
Okay.
talk about this for a while. Because,
Okay.
look, if you're just entering this world, there's corporations, S corporations, LLCs, PLLCs, there's all these acronyms and rules. And people oftenly, boy, there's a great word. People often will think of S corporation, well, that's a small business corporation, hence the S. Well, it kind of is, but that's not officially why it's an S corporation. As Beverly indicated, it's following the rules in subchapter S of the IRS code. Okay, that's why it's called an S corporation. But the term small fits. Why? Well, fewer than 100 shareholders. IBM, Apple, they cannot be S corporations. There's only one class of stock. That's very typical in smaller businesses. The shareholders are limited. It has to be individuals, estates, or qualified trust, typically from the estates. And the estates and the qualified trust are enduring to the benefit of an individual. So they're like extensions of an individual. So really only people can own stock. Okay. Other companies can't own stock in an S corporation. And then, of course, the non-resident alien. So the reason there's a little confusion as subchapter S corporation, meaning small business corporation, is because the limits that are placed on an S corporation fit within the framework of many, if not most, small businesses. Anyway, I wanted to point that
Well,
out.
thank you, Lance. That was really well said. Thank you. All right, so before a corporation can file as an S corporation, they must make that election by filing Form 2553, and all shareholders must consent to making the election. So, Lance, I do have a question here. So, if a corporation meets the requirements to elect to file as an S corporation, of course, they file on Form 1120S. Are corporations, and you kind of covered this a little bit earlier, are corporations the only type of entity that can elect to file on that form?
The answer is no. LLCs can, in fact, elect to be an S corporation as well, as can corporations. Now, a quick word about that, though. People think, okay, well, I'm going to go through my first year, and during my first year, I'm going to decide whether I want to be an S corporation or corporation, depending on the results of my first year. It doesn't work that way. If you want to be accepted and recognized as an S corporation, okay, you have to file this form you have to file it by March 15th, I believe it is, and be accepted within so many months after that before you can be treated and file your first tax return as an S corporation. If you fail to do that, you file your first return as a C, and then you can elect for the following year to be an S corporation. So it's not a decision that should be taken lightly, or I'll do it later. No, you need to think about that up front. If somebody's coming to you wanting help in what entity do I select, well, then be aware that if they're already a corporation, they can be an S corporation, but they're going to have to probably go through one more year as a corp before they can make that election. Okay, and also the consent. You have to have written consent from each shareholder, which most of the time is never a problem. It's 2 or 3 people, it's a handful of people, but in the larger ones, where there may be upwards of 100, that can sometimes create a problem in wanting to make that election. You typically don't see that being a big issue, but it does come up where somebody goes, no, I'd rather get dividends than not be double taxed. And I think we're going to cover double taxation here in a little bit. But I think that so really the only ones that can are LLC and corporation.
Okay, thank you. I do actually have one more question about this. Are there any salary requirements?
Oh, okay. Interesting question. So, no, there's not. Okay, meaning officially, there's no a shareholder of a subchapter S corporation must take X number of dollars. Okay, shareholders of corporations don't get a salary; they just get dividends. That's double taxation. Again, I think we're going to cover it later, but think of it this way: the corporation's paying tax, and then they're pushing out dividends, and the dividend owners, the stockholders, are paying taxes on the dividends. Now, on an S corporation, it's pass through. So if the S corporation makes $100,000, well, let's say it's a 1040 single owner, they're going to report the $100,000 on their income tax return. And it's not subject to self-employment tax if it's coming through an S corporation. But what if it's self-employment income? Now you have a problem. You should have salary as part of that 100,000. If you're the manager, owner, operator of an S corporation, and I'm going to use these really round numbers of $100,000, you should pay yourself a reasonable salary, or else you're going to have issues with respect to, okay, you're getting your investment on your $100,000. How are you earning a living? You cannot be just a dividend holder. You will need to be an employee or getting paid as somebody who is working in the business. So the best way to do that is something we call income splitting. I won't go into great detail, but if a reasonable salary for somebody doing what you're doing is $50,000, and your S corporation makes $100,000, you can take $50,000 as wages, pay your employment taxes, do your withholding. The other 50 can come to you as profits from your S corporation. They are not subject to self-employment taxes, saving half the employment taxes you could theoretically have to pay if you treated it all in salary. Now, again, there's lots of nuances of this. We're going to mention Answer Connect here. This is where things like Answer Connect can really help you understand the concepts of reasonable compensation and the type of income that is getting passed through. But it's not required, but it is certainly recommended that if you're a single owner of a operational S corporation that would ordinarily be getting self-employment tax, you should at a minimum split out part of that as salary and pay your employment taxes.
Mm-hmm. Well, thank you, Lance. So let's do another polling question. Can a corporation selectively file annually as an S corporation at their choosing?
Well, it's swinging to the no, but there are some yeses out there. About 3/4 of the votes in. We'll let them go a little bit longer.
Well, for
And
those, yep,
it looks like it's going to be a no. Now,
yep.
little tricky for those who said yes. Don't feel like, oh wow, I missed it. We did talk about how a corporation can elect to be an S corporation, but it's not something that you could selectively do each year. Once you make the election, you should stick with it. Okay. Once you decide to elect, now why? Well, there's a number of factors. Again, we won't go too deep into those, but your earnings that have accumulated as a C corporation are still going to come to you as dividends you got to pay taxes on. But if you elect to be an S starting in 2021 and over 23, 22, 23, and 24, you make money, when you're going to pay taxes on that money on your 1040, and then you will be able to pull that money out of the corporation without paying tax on dividends because you already pay taxes. So there's different pools of retained earnings, for lack of a better term. There's AAA and earnings previously taxed. Again, not great detail today, but just letting you know, your retained earnings becomes a different buckets, and your taxation is based on those buckets. Now, if you start life as an S corporation and always stay an S corporation, you don't have the problem. Now, if you start life as an S corporation and you lose your S corporation status, What? I could lose that status? Yes, you can. It's rare, but it can happen. One, the salary issue could be a problem, right? Two could be um, 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 disproportionate distributions. If Beverly and I are 50-50 in an S corporation, but I'm getting 75 percent of the extra money above salary, and she's only getting 25%. You can do that in a partnership, but you cannot do that in an S corporation. That will bust and nullify your S election, and you will be taken back to C again until you can get an S election approved. And I believe it takes 5 years before you can be an S corporation again. There's a timer, and I think it's 5 years.
Mm-hmm. Mm-hmm. All right, thank you. Well, that kind of leads into, we were talking about double taxation.
Yep.
So what does that mean? And Lance covered some of it already, talked about some of it. So a
So
corporation, yeah, I'm
go
sorry,
ahead.
go ahead.
No, go ahead, Beverly. You do your thing. Yep.
So a corporation is a separate entity that can be subject to double taxation because, as Lance said, it's taxed on its taxable income at the entity level, and then again, when dividends are given out to the shareholders, taxed on the shareholders' individual tax return. But a subchapter S and also partnership returns, they're not taxed. Their earnings and losses are reported on the owner's individual return. So this kind of leads into another question for Lance. And now, of course, no one wants to be double taxed. So is it best to always, well, you kind of cover that, to make that election? And
So
which kind of leads into, what would you say to a new client who comes in and that wants to make that that made that election previously?
So, great question, and you're right. For the most part, we never want to be double taxed, right? I mean, who does? That sounds so horrible, but sometimes it still makes sense. And when I say that, depends on the nature of the corporation. One of the best things about it, I mentioned income splitting, about incorporating. If you're a small business and you want to incorporate to become an S corporation, you can do that income splitting, right? Whether so that on your Schedule C, you're not paying self-employment tax on all your earnings, right? You're going to have a W-2, and then on Schedule E from the K-1, you'll have some earnings from the S corporation. That's not double taxation. You're only taxed once and at different levels, depending on type of income. However, that being said, sometimes, rare, mind you, but depending on the nature of the operations of the corporation, et cetera, double taxation may be required. You may not be able really to organize as a corporation or as an S corporation because of too many shareholders, wrong types of shareholders. Maybe this business is going to need to be a part of the ownership structure of the new entity. You're just going to have to accept double taxation in some cases. Okay. So, and if you've been a C corporation and you want to get out of it, you're going to have to by doing the S election, you're going to have to get taxed doubly one more year. And typically those discussions come up when those taxes on distributions become big, and it really hurts when you tell somebody you got to go another year and pay those higher
Mm-hmm.
taxes before you can. I actually encountered that with a client who had a real going business. He never really went S because it didn't make a lot of sense at the time, but all of a sudden his business started exploding. There was a lot of extra money over and above what his salary was, and he was having to pay it on dividends, and it was hurting him. It was hurting him.
Mm,
Now we made the
yeah.
election selection, but when I had to tell him he had to pay another roughly $25,000 in tax one year because I couldn't make him an S today, he blamed me. But I
Oh
told him
no.
I can't help it. No,
Yeah.
we get
Yeah.
blamed. We get blamed. No, it's
Yeah, I
IRS that
know.
does that, not me. But we get blamed, right? Yeah.
So to recap, both corporations and subchapter S corporations are corporations that enjoy the aspect of limited legal liability for their shareholders. Corporations are taxed as separate entities. All items of income and losses are computed at its level. The corporation pays the federal tax, but then when the shareholders receive dividends, those are taxed again on their individual tax return, so that double taxation. And subchapter S corporations, not taxed. its income and losses flow to the shareholders. So what do these return types look like? We are going to see what a Subchapter S return on Form 1120S looks like in one of our tax software solutions, Taxwise Desktop. There are two Taxwise tax platform solutions, Taxwise Desktop, and since 2007, there is a browser-based version of it, Taxwise Online. So to let you know, if you are currently doing your client's individual and business returns in Taxwise Desktop, coming soon in November, in Taxwise Online, you will be able to prepare those individual returns, and we're also adding forms 1065 and 1120S. And we just had an overview of some of the different entity types, and Lance answered a whole lot of questions for us. It's like he is Answer Connect, but maybe you think of some questions afterwards. We have CCH Answer Connect, which is a comprehensive tax research authority. So let's go take a look at Taxwise Desktop. And signed me out. Let me sign back in.
Actually, before we do, don't we have a quick question? Or did my
Oh,
deck
did
change?
let's see, maybe yeah, maybe so, oops, let me see. Well, go ahead and
Okay, yeah, and we won't do a formal poll while you kind of catch up there, Beverly. Yeah, it's really a true or false, and you can put it in chat, or I'll just let some time
oh,
let
it
you think about it.
is. I'm so
Yeah,
sorry. Yes. Yeah.
that's all
Okay,
right.
let me
Do you want
go
do you want to
back
run the
to
poll?
that.
Okay,
Yeah, let me do that.
there you go. So that's true or false. Will a shareholder in the corporation receive a K-1 reporting corporations' incomes and losses? We'll let these vote up a little bit more. Leaning towards the false. And we're about 3/4, so we'll go ahead and unveil here. No, a corporation will not issue Form K-1. As a matter of fact, you have probably, if you're doing individual income tax returns now and haven't really got into the business world yet, as far as business returns, but you've done 1040s, well, you've seen what a corporation will issue its shareholders. It's a 1099 DIV, dividends. So remember, corporations pay their taxes, and with the money they have left over after taxes, they're paying dividends to their shareholders. So they issue 1099 DIV. An S corporation, though, is passing everything through. So it's going to issue a Form K-1. So the answer is false, because an S corporation will issue a K-1 to the shareholder. Okay,
Right.
and I think you have an example of a K-1.
I did, and I was gonna, yeah, let me go through that and show. So we'll see. We're gonna take a look at a 1120S return,
Okay,
and this is what the K1 is going to look like. This is a printout of one coming from Taxwise Desktop, and we'll see that John Smith, he's a 60% shareholder, and we'll look at that a little bit later. So this is 60% of his earnings from the entity for the business income, interest income, ordinary dividends. This will be reported on Schedule B of his 1040, and ordinary business income will be reported on Schedule E of his 1040.
so before you
And
move off this slide, because we're going to go to Taxwise next, I think, but real important to know, when you're working with pass-through entities, and 1120S is a pass-through entity, okay, notice how the K1 is structured. Basically the same characters of income that you see on Form 1040. Ordinary income, interest income, dividends, royalties, going down the line. You'll see cap gains too. So when you pass an item from an entity to an individual, it retains the character of that item, and they get the same tax treatment because so each one of those items will be treated as it would be on a 1040 for that individual. So important to know that character does not change when income passes from a passive entity to a shareholder or partner. Same rule applies to 1065, by the way. Okay, just want to point that out.
Right. Okay, great. Thank you, Lance. So this is Taxwise Desktop. It's a comprehensive desktop solution designed so you can be up and running, designed for the preparer to get returns out quickly. And on your dashboard, the task that you do most often, where you can start a new tax return or open an existing return. And in desktop, you can prepare those core return types, of course, those 1040s, business returns, including the partnership returns and Form 1120S. And on your dashboard, wanted to point out that you also have additional resources, your solution center, knowledge base. You'd go in, type a keyword, and that can help you prepare in the software, and you have your tax help. So let's look at some existing returns. So to see what it looks like when you prepare those 1120S returns. And then we'll go into a 1040 return to see how that income from the entity flows into the 1040. So this is like your return manager. It is your return manager where your returns live. We are going to open up an 1120S return. See what that looks like. And this is page 1 of the return of the 1120S. So you have the entity's income, cost of goods sold, and the deductions. And notice your forms tree over on the left. You can hop on over to the different forms and helping you prepare. When you see these blue check marks, those forms are complete with the required information. But when you see red, that means that's letting you know that required information is missing. Got to get that read out before you can e-file. You've got your tabs up at the top. So we're going to add a form. This is where you would go to add a form. Type in that form. That you can open it there. And for those business returns, type in that trial balance. And this is a feature that you will love. Makes it so easy. Over here, you've got your assets, enter those liabilities. You've got your income, your sales, rental income, your other income, and over here on your expenses, cost of goods sold, as well as other expense types. Now the inputs flow over to the corresponding forms and the balance sheet. You'll have your balance sheet on page 4. Schedule L is your balance sheet. So you may know this already, but generally there is a requirement to complete Schedule L unless the gross receipts of the tax year and total assets at the end of the tax year are both less than $250,000. Then Schedule L, the balance sheet, is not required to complete. So now some of your clients have depreciable fixed assets. So let's go to page 1 of this 1120S. We're going to go to line 14. That's going to link me to the 4562, taking me to those fixed assets. So you would type in a description. You've got the drop down for the asset types, the date placed in service, its cost, and you can check that this asset qualifies for bonus depreciation. Now to navigate to the different forms, of course you can navigate to the forms on the forms tree. but also notice the buttons up at the top. You can navigate to the previous form, the next form, and this is where you would print the return out, or maybe you want to print the form. You can check your diagnostics, and here you can connect to another product that we offer, CCH iForm. CCH iForm for the portal, two-way document sharing between you and your client. So you could go to the print return button, send the return to your client, securely encrypt it to the portal. Now, we were just discussing that subchapter S entities, they're not taxed, and their entities or their earnings flow over to the shareholders to report on their 1040. And they are reported, that the earnings are reported, the shareholders' earnings are reported on Schedule K1. So this is John's K1. We looked at what it looks like when it's printed earlier. And you will see, as Lance said, looks like a lot like a 1099 that you've seen that your customers receive that report the interest and dividend income earned. So this K1 will show that John Smith, a 60% owner of this entity. You see the fields or boxes reporting John's share of the income, that dividend and interest income reported on Schedule B of John's 1040, and box 1, the business income, ordinary business income. This is 60% of the earnings of this entity that will be reported, Schedule A. So now in Taxwise, when you prepare the 1120S tax return, you do have the ability to import this K1 into the 1040. All right, so let's go and look at what those returns look like when the K1 flows into John's 1040.
As you're transitioning, if this is all new to you, and you're thinking, wow, this whole new form set's rather intimidating, it's really not. If you're familiar with financial statements, and you've got an income statement and a balance sheet, or just a trial balance, you've gotten 80% of the return done just having the trial balance information, the income statement and the balance sheet. The stuff in between, income statements on line 1, on page 1, the balance sheet's on page 4. Everything in between is information relating to the entity. Did it file any 1099s? Yada yada, a bunch of questions. But you're 80% or more there if you've got a balanced trial balance for an entity. You're 80% of having that return done. So don't let it intimidate you if you're new to this. It's not as intimidating as it may sometimes look.
All right, thank you, Lance. All right, we will open, so this is John's 1040, and the 1040 tax data entry opens to the main information sheet. And the information that you enter here, John's name, address, date of birth, anything on the main information worksheet does flow over to the related forms on the forms tree on your left. This looks very similar to what we were just looking in. You see the blue marks indicating that the form has complete information, and the red indicating that you cannot e-file because there is some incomplete information. And you also have, I want to show you what you have in the 1040. You've got a refund monitor. It's an intuitive tool, such as you can see input flips right away. You've got both the federal and the state. And up here, we saw the buttons in the 1120S return. You have similar buttons. You print a return, print the form. You've got your diagnostics and iFirm, and you also have the ability for e-signature, the e-signature button. And you have the ability to import the K1 we were looking at earlier into the 1040. And I did that previously, import it into John's return. And that K1, the K1 inputs flowed into this return. We're going to take a look at what it looks like on the 1040. Flows in the inputs you see, and those inputs will flow over to the tax return to the related form. All right, well, let me go back. We're going to go back. We just looked at John's K1 and a polling question. Would you like more in-depth product demo and further details about Taxwise?
This one looks like a real race here because the folks that have already using Taxwise online are marking, they're kind of slowly adding. Yes and no is kind of neck and neck. So look, I got some folks that saw some things here that they're interested in looking at. Others may be really interested, but go, no, I'll do some more research first. All right, we've just about got that, and I noticed we're running short of time, so let's move. It looks like, and listen, if you indicated yes, you'd like more information, we'll reach out to you. If you're already using Taxwise Online, we got some great news. Beverly's explored that already. I think it's on the next slide, though, Bev. Let's go ahead and move over to the next slide. I think that's it.
Yeah, so
Yes.
coming soon, the online, let me start all over. Coming soon, the online version of Taxwise, the desktop, the online version of Taxwise software we were just in since 2007, Taxwise Online. It is a browser-based version of desktop. It's going to be coming in November. And you're going to be able to, in addition to preparing those individual tax returns, we're adding 1065 and 1120S forms to Taxwise Online.
So
And
let me jump in here because this is something that here at WK we've been very excited about. We've been working towards. Taxwise Online has been very popular over the last 7 or so years. Been focused on 1040 returns. We've been wanting to bring the business return capability to Taxwise Online. By the way, if you're a Taxwise Online user now and you want to start doing business returns, great. Desktop will take care of those. Okay, so you have an option to do business return today, even if you're currently a Taxwise Online user and doing only 1040s. But coming in November, as Beverly indicated, 1120S and 1065 are coming to the online platform. So now being able to work within one platform and adding those business returns, we're excited about it. And from what we understand, a lot of our customers are excited about it coming too. So keep an eye out for it. We're testing it now and working through it now. By the way, we're going to have more sessions similar to this that'll focus more on Taxwise Online and how it can help you with your 1065s and 1120Ss. Those are what we're going to start with. Will you be able to do other business entities that we talked about down the road? Yes. But remember, LLCs are going to file either a 1065 or 1120S. A partnership is going to form a 1065. All right. An S corporation is going to form 1120S. So you got 3 of the 4 covered right away, just because LLCs can use either form.
Right. Thank you so much. We're all excited about this. And I know we're almost out of time. I wanted to thank Lance for all of his answers. He has so much knowledge, and he has the ability to make it sound interesting. So
well, you made a comment earlier, and I want to get one more plug in for Answer Connect. You said something earlier to the effect he sounds like Answer Connect. Listen, the only reason I know what I know is because of tools like Answer Connect. There is no way even though as I tell my kids daily, I'm the smartest person they've ever met. They don't believe me, but I tell them that. And I tell my grandkids now, and they roll their eyes more than my kids did. But that's beside the point. It's not about inherent knowledge. It's about having resources at your fingertips. Taxwise Online It has the resources that you need. Taxwise Desktop has resources. And then when you need to get into the law and structure and which one is better and which one should I consider, there's a great amount of content at Answer Connect. So don't forget that. Put that tool in your bag if you don't have it. That's how you really get to know the depth and the breadth and depth of reporting in business entities. And when your clients and customers start coming to you for that advice, you'll have that at your fingertips so that you can help them make the right decision.
Well,
Right.
thank you both. We do have a few questions if you guys are willing to stay on a little
Sure,
past time. They've come up earlier in the meeting. So,
sure.
um, Madalemi, I hope I'm pronouncing that right, asked, when you refer to an S corporation and that it can't be a non-resident alien, do you refer to a person that has a green card or a person who has a substantial presence test? I guess she's asking, is there a specific, if they have a green card or if they have a substantial presence test, does that preclude them from having an S corp?
That is a great question, and I don't off the top of my head know that. We could get that answer from Answer Connect, right?
Nice.
But yeah, and so we can forward that potentially afterwards.
Yeah, yeah,
And
no worries. We
yeah,
can follow up.
but off the top of my head, I'm not 100% sure, and I don't want to give a wrong answer.
Okay,
So we'll have
okay,
to
no worries.
follow up on that one. Yeah.
I'll just go through them and a lot of these are tricky. So,
Yeah.
William had a question. Can a member of a LLC being taxed as a C corp still qualify for a 1202 exclusion on complete liquidation?
Okay. So a member of an LLC should not be getting taxed as a C corporation. There's a structural problem there anyway. And that structural problem might get in the way of the total liquidation that you're thinking about. Um, that one, I mean, I would say if that's happening, yes, but it really shouldn't be happening. There's something not right in the structure to begin with. That being said, an effort to make that use that liquidation methodology might be flawed because it really can't exist. It's like me trying to file a partnership return and I only have one partner, like we mentioned earlier. I can't. So I got to fix the structure before I can fix anything else. I know that's not a great answer, but that gets into
No, no, that makes
some
sense.
issues. Yeah, that
That
gets
makes
into
sense.
some technical issues that I would actually go back and say, how is this possible, and then
Right.
reconstruct it from there. Yeah.
Okay, cool. Mylene has a question. Can you file late election and how late in the tax year can it be done and for what reasons?
Okay. Theoretically, you can. Oh, while y'all are stretching me here, I think you could, with due cause, with reasonable due cause, I think you can go out to June, but I don't think it's anything past that. So March 15th is the election. It's well before the end of the year. I'm thinking June 15th off the top of my head. It may be as late as September, but you won't know the annual results right before you can make that election. So that's kind of what people are wanting to do. Let's see how we do this year before we elect. It's if there is a late election, it's due to reasonable circumstances, which in itself is a hurdle to climb, and so it's best to do it within the 315 timeframe.
Okay, perfect. And then Sadat had a question. Salary for the owner of S Corp only comes to okay when you have profit? I'm not sure.
Okay, okay. No, listen, that's okay. Boy, you just hit a pitfall of reasonable salary, right? And dealing with that. Using my $100,000 example, if $50,000 is a reasonable salary, somebody earns 100,000 in the corporation, 50,000 of its wages. Hey, guess what? You get $50,000 worth of income that's not subject to employment tax. But what if the company only made $25,000? Well, if you borrow money to continue paying bills and you pay yourself the salary, you're still going to put that $50,000 W-2 on your 1040, but you're going to have a loss on your 1120S flowing through to you. Okay? So it's important that you keep, if you set a reasonable salary, you keep it, even if it cuts it close or takes you a little bit negative. Of course, you have to cash flow it, But the reasonable salary, if that's what you're using to split income, needs to be a reasonable salary. Now, is it reasonable for me as an owner of a single owner of a corporation, S corporation? I paid all my other employees, but I can't pay myself my full salary. Yes, you could do that. But if you borrow the money to pay yourself the salary, you will actually bring in a loss on the S corporation side. Hope that helped.
Definitely. And then Emily had a question. This was earlier, so she's in. Can you repeat that? I'm confused. So you can't have a shareholder at 25%.
Um, okay, ask that again. I want to make sure I got the question right.
Yeah, I don't know. I'm sorry. It's very out of context given it's so late. She asked if you
Yeah,
can't have a shareholder at 25%, and I don't know.
of,
I can't.
of course. Oh, sure. A shareholder can be 0.5%. A shareholder can own it. Well, I say point. Listen, shareholders are different when you think about its number of shares. Most corporations are organized with a round number of shares. The typical small corporation has 1,000 shares of common stock. If I have 250 of those, I own 25% of that corporation. I am a 25% shareholder, but and I'm going to get 25% of the activity from that S corporation. Okay. But it's really a share count more than it is a percentage. It's the percentage is expressed based upon number of shares out of total available shares. Okay. So yes, you can have a 25%. You can have a 100% shareholder. You can have a 1% shareholder. They own one share of 1,000 common stock. So there's no limit there. Where you get into half shares, I guess theoretically you can own half a share, but boy, I wouldn't go there. Hard to explain.
Yeah, so I guess Emily clarified. He said that one shareholder had 75% and the other owning 25, and that would be incorrect. So I was confused.
Oh,
Is
of
what?
course you can do that. No, no, of course you can. And oh, absolutely, it does. That doesn't have to be equal ownership. If I own 20%, right? Beverly owns 80%. That's great. Now we may be doing the same work and getting the same salary, but the distribution of earnings, 80% is going to be hers and 20% is going to be mine.
Okay,
So there's
perfect. She said
they,
that makes sense. So, and
okay.
also
Yeah, it
shout out
doesn't.
to
Go ahead.
sorry. I was gonna say shout out to Emily. She also said Taxwise is really user friendly if you understand tax forms and where things go.
Oh, no question, no question. I used some of our other products that Walter School has in my practice, but could I have used this? Oh yeah, absolutely. Oh yeah, I'm a big fan of TaxWise, even though I've used some of the higher dollar big firm, they quote unquote big firm software. Yeah, it's great. This stuff, I love it. I can knock
Hmm.
out 1040s and basic 1120s a lot quicker with TaxWise than I could with the other stuff. Not as clunky.
Hmm.
And we have Nayeli asking, what business entity would use 1120 without the S?
Just a corporation. If somebody incorporates and says I'm a corporation, file my return. It's 1120. And the only thing that would change that is if they decided to be treated as a pass-through entity and made the subchapter S election. But just because you're a corporation doesn't mean you have to do that. But if you want to be an S corporation, you have to make the election.
Okay, let me get through a few more. Thank you for sticking it through. Um, Mayor asked, I have a question about an overseas LLC registered here. How will that be taxed since the member is overseas without a social or local ID?
Okay. Um, I there are going to be some structural questions which may get too deep here. However, if the in it depends on the source of the income. If it's owned outside of the U.S. but the income is generated in the U.S., that's where it's going to get tricky, and it may depend somewhat on the shareholders status. And I think again, an LLC, remember, doesn't pay its own taxes, so it's going to flow through to the individuals, and their particular tax situations are applied. So I know a little bit more about if you've got an LLC that's organized, maybe it owns some real estate overseas and domestic. Well, as a U.S. taxpayer, I'm getting taxed on what? Global income. Now, the tax might be different how it's calculated and how it's applied, but I'm getting taxed on both the overseas revenue and the domestic revenue. Now, if it's an overseas LLC member, they're going to get their K1, okay, and then they're going to be subject to their rules on how to treat that.
Okay, great. Thank you, Lance. Juan had a question, which I can answer, I guess. How do I have access to the business forms in an individual Taxwise Online? So currently, Taxwise Online does not support business returns. However, all Taxwise Online users have access to Taxwise Desktop, which does have business returns. So you would just need to use Taxwise Desktop to access business returns currently. However, by the end of the year, we will be releasing uh, certain forms to Taxwise Online, so you should be able to see those later this year in Taxwise Online without having to use desktop. And then Daniela asked, why is it recommended that only shareholder in an S corp has a reasonable salary?
Okay, if you as a business, okay, and I'm going to use my sole proprietor accounting firm. I do taxes for people. They pay me. I can just be a Schedule C. All my revenue goes on my 1040. All my expenses go on my 1040. I pay employment taxes in the form of self-employment taxes, right? I pay on the net. Now, let's say I make $250,000. I could wish in a sole proprietorship CPA firm. Okay, but you know what? I could hire a manager to run that for me for $150,000. If I pay myself a reasonable salary to manage the business, the corporation can pay me $150,000 in salary, and then the corporation can distribute the other $100,000 to me as the owner, and I don't have to pay employment taxes on that. That's the advantage. That's what we call income splitting in many cases. Now, be careful about that. Well, I've declared that $20,000 is a reasonable salary to manage this firm, so I'm going to take 230. Is that going to be reasonable? Probably not. Is 150,000 reasonable? Who knows? But you're looking for industry standards. You're looking for methodologies that are used in common practice in your industry, and you're looking for guidance tools like Answer Connect. I'm going to throw another plug in there. Things that can help you make those decisions on what is reasonable compensation. It'll define it for you, and it may be very different. I had a lot of professionals, doctors, veterinarians that would have been sole proprietors, but they were taking a salary, and then they were taking distributions and saving some employment taxes. We just made sure their salary was reasonable. It's a kind of a hard concept to get in a couple of sentences, but there's content out there that'll help you determine, if you're in that situation, what a reasonable salary would be for that business.
So
I'm
another
gonna
question.
I'm gonna
Sorry.
need to leave because I have another demo I'm doing. But I wanted to thank everybody,
Oh, you bet.
and I look forward to working with everybody in the future. And thank you so much, Lance.
Oh, you
Um,
bet. Thank you, Beverly, for inviting me.
all
Yeah,
right,
thank you so much, Beverly, for hosting. Sorry, I usually we don't run over
bye
this
bye.
far, but I think
Yeah,
people are really enjoying your answers. So,
that's fine.
uh,
No, that's fine. And I'm good. I'm good for another 10 or 15 minutes if you need me.
okay. Nayeli also had another question. Using the 100K earnings example in an S corp, if a shareholder
Yep.
paid himself 50K in wages, how would he receive the other 50K in profits? Does it have to be 1090?
No, that's what's going to be on K1. Okay. So think of the K1 you just saw. And let's take that $100,000 example. I'm going to, as that recipient of that $100,000, I'm going to get what, a $50,000 W-2. And then on my K1, the net income number on that line one is going to be 50,000. Why is it only going to be 50? Because the company's going to deduct the 50 in wages they paid me. They made 100. but 50 of that came to me in wages. The other 50 comes out as on the K1, and that goes on Schedule E of the 1040. Now, people say, well, I don't know how much my salary is going to be. Look, salary does not have to be paid every month, every week. It can be paid in the form of bonuses or whatever. Many single shareholders who use a salary strategy are paying themselves a minimal monthly salary just to pay the mortgage and whatever. And then at the end of the year, they pay themselves a bonus, do the withholding and all that. And those of you who did payroll taxes know that as long as you report it as it's earned and as it's paid, it doesn't matter if it was at the end of the year or the first of the year. You just have to report and deposit the taxes in accordance to when it was paid. I used to have a customer, one of the first S corp strategies I ever worked with. I was with a big firm in San Antonio. Guy had a pretty solid business, and this was mid 80s, mid to late 80s anyway. And he was making $150,000, which was a lot of money back then. And he would not take a salary at all. He would take some distributions that he needed to pay his own personal monthly bills. At the end of the year, we did one big calculation, wrote him a big old bonus check. Well, by the time we withhold and consider what's already been paid to him and all that, the actual net check may have been a couple $100, but it was true. But we booked everything as wages, as withholding, and as distributions, and it worked out really well. That's not for the faint of hearted, by the way. Don't go in with a strategy like that. Okay, that takes a little practice. Fortunately, I was working for a firm that taught me how to do it. But be careful. That's possible, but don't just that's tricky. The best thing to do is take a salary, a regular salary out, and then if there's an opportunity for a bonus to do some income splitting, great. You can do that at the end of the year. You got to do it before the end of the year so you can get your payroll taxes in. But the most common practice is to pay yourself a reasonable wage, a reasonable even wage, just like you were hiring somebody. Then you could say, no, that's what I would have had to pay somebody else. That's why it's reasonable, and move on.
Perfect. Thank you, Lance. Really appreciate it. People are saying great webinar. Thank you. So people are enjoying this very much.
Good, good.
Another question for you. What is the advantage of forming an LLP or even the newer LLLPs in a few states for certain firms such as accounting and lawyers?
Great question. So that the P designation that you see, like PLLC, that stands for professional LLC, professional limited liability company. Let me talk about that real quick. Certain professions, doctors, attorneys, CPAs, others that are licensed, I cannot, I can have legal liability from somebody in my building slipping and falling, but I cannot have legal liability against my own decision making. So there's a special category for corporations and LLCs when a professional is involved, because their liability is limited on normal operations, but not against the judgments I make inside of my profession. So if I was to be an LLC, I would have to be a PLLC. Now, a little bit different when you talk about a limited partnership, an LP, versus a GP, general partnership. So I'm not sure which ones you were talking about, but just to know, limited partnerships make sense. If it's more of an investment, you're going to have a general partner who calls all the shots, makes all the decisions, and has all the responsibility. And then your limited partners are investing. They may have their investment at risk, but their personal assets are not at risk for anything happening in the partnership. But all LPs, limited partnerships, have to have at least one GP, general partner.
Great. And then I think that's maybe the final question. Mylene asks, is spouse working in S Corp business subject to same reasonable wage?
Say that one again.
Is a spouse working in an S Corp business subject to the same reasonable wage?
Great question. Theoretically, no. Now, if the only person working in it is the spouse, I would tend, in other words, let's say it's just use classic husband and wife. Husband owns the S corp, wife's running it. Well, if you're not paying the person who's running it a reasonable salary and it's all going on the same return, I don't know what kind of legal ramifications there are, but I wouldn't want to have to answer those questions sitting in front of an agent. So now, if one of the two is already making a reasonable wage and the other one's making less than reasonable wage, that's fine. I've done that 100 times because maybe you want the spouse to work in the business to get the insurance benefits, so you pay them a less than reasonable wage, but the primary owner spouse was making the reasonable wage. This it happened to me several times where in one case, she owned the business, she was incorporated, she was paying herself a salary. Hubby was a rancher, didn't have a source of insurance attachment, right, except open market. So she hired him on a part-time basis, and he became an employee and could get benefits off her plan.
Mylene says, thank you. So
Good.
I think that brings us to our conclusion. Thank you so much, Lance, and I really appreciate everyone who joined, and especially people who were asking questions. These are some great questions. Hopefully
Yeah,
we
they
can bring
were.
Lance back sometime soon because you're a star, man. Everyone is loving this. So thank you
Well, and,
guys so
and
much.
listen, I love the questions being this detailed because that means they were listening, right? That means I wasn't just dry and boring. So that always
Yeah,
makes me
yeah.
feel better. Yeah,
No,
because this
this
stuff
is
can get
amazing.
boring. Yeah, this
No,
stuff can
thank you
get
so much,
boring.
Lance. And if you found this session to be informative, please be sure to join us. We host these once a month, and we'll be sure to bring Lance back like every month now. So
All
awesome.
right.
Everyone has a great day. Thank you so much.
Take care, everybody.